You may have $1 million in your portfolio, but you can always have 5 million. To make sure that they are secure and profitable at all times, creating a higher chance of making you very, very wealthy when you retire. But if you did this every month for 30 years, then you would have $3 million. But no, you can gain a lot through this investment. This is what makes billionaires. These are people who instantly regret selling. Spread the wealth. Today we're going to talk about expanding your investment portfolio. We're going to talk about expanding more than just your retirement account and a couple gifted stocks. Welcome everyone to Don't Fear Finance. I find investing a requirement, not a choice. Today I want to look at how you can increase how much you have in your investment portfolio, value and diversity wise. There are so many aspects to expanding your investment portfolio, but today I want to speak about the actions you should take while expanding your portfolio. Before we continue, make sure to like and subscribe and comment down below saying that you did and hit that bell icon so you'll be notified every time I upload. Now into the video. The first thing that is important to do when you're trying to expand your investing portfolio is to be very consistent. The more consistent you are with the majority of things, the easier it will be to accomplish whatever you're working towards. Be it becoming super wealthy or super buff, it requires consistency. This is very true when it comes to your investments because obviously the more you invest, the more you have in assets, creating a higher chance of making you very, very wealthy when you retire or the next few years if you know how to do it. The best way to make sure that you're investing consistently is to make your payments and contributions automatic. With the day and age of technology being very prominent, you can make things so much easier through making things automatic using the technology we have. When you buy investments, you should always buy and hold, as this will be more effective as you're trying to beat the markets. Let's look at an example of investing consistently while using the method to buy and hold. You invest $500 per month into the S&P 500, which has an annual 10% return rate. If you only invested in this fund once, then it would be worth around $8,500 after those 30 years. But if you did this every month for 30 years, then you would have $3 million just by investing $500 per month for 30 years. With compound interest and consistency, you just allowed yourself to be a millionaire when you retire. It is sort of like working out. You won't get buff and have abs by working out once every other month, but if you do it all the time consistently, you will over time start getting abs. No success comes from inconsistency. Next, take risk, but proper risk. Investing is betting on the unknown future. You need to be alright with risking a lot to keep up with inflation and to keep making money. Although there are many investments like the US Treasury bonds that are considered safe, they still have risks and they may not keep up with inflation. There are always risks with investments. This is why you may want to invest in things that are riskier and have higher returns. When we're talking about risk, we mean that you aren't being stupid. This means that every risky move that you make is calculated and studied down to every single last point. This is why in the investing world, we call this calculated risk. There has to be a high tolerance of the thought of losing money. You need to get to a point where you know that you can lose a lot, but know you can gain a lot through this investment. Remember though, having too high of a risk tolerance is something that could end your profits for the next few years because you don't think you'll lose money because of overconfidence. No matter what happens, if you have high profit gain or high profit loss, you should always watch your confidence. There are some investments that high risk tolerance is a very good thing to have. Things like real estate. You may buy a property but have no tenants. During that time, you'll be losing profit. People who are willing to go through this have high risk tolerance. High risk tolerance is what makes billionaires, but it's also what makes gambling addicts. Don't be stupid, be smart and calculated, and you will receive high returns in the long run. Next thing is to not get emotional over investments, especially in the markets. The reason why people sell is because of short-term dips in stock value and due to the worry of losing that money that they invested. The dip in price short-term doesn't matter unless it goes under your sell-off point. In the long run, people who buy investments under value make a very large profit. These are people who see this so-called loss as a win. They buy into the markets when the prices are low and they sell when the markets are high. They understand the concept of buy low and sell high. The people who panic sell are the people who in 5 years will be throwing their hats at the ground, cursing off the world for such a bad wave of loss and luck. These are people who instantly regret selling. The second part of this point is how you should never be too upset when you lose money on an investment. The reason? You learn to invest. You learn how to invest, when to invest, and when you should pull out of the markets when the values dip. Letting your emotions dictate when you buy or sell is the investment equivalent to impulse shopping. Diversification. This will increase your investment portfolio's chance of high returns while minimizing risk. You could use this method in any type of investment, be it stocks or be it real estate or anything that you can grow money in. Having many different types of investments will let you endure those great successes of each type of stock or investment or ROI while standing up to waves of losses. The best way to describe diversification is that it's like a wall. The more support you have at the base, which in this case would be your many different types of investments, the harder it will be to knock it down and make you have to rebuild. The safest way to do this is to follow these next 4 steps. Number 1, spread the wealth. It is important to have equities in certain high profit industries or companies, but don't put all your eggs into one industry or company. Creating your own mutual fund with different types of stocks and equities and things that you trust and use on a daily basis is the best idea to create sustainable wealth. This could include real estate, commodities, etc., not just stocks and ownerships and companies. Number 2, investing in fixed income investments. Investing in things like index funds and government-issued bonds are very secure with their consistent streams of income through interest and consistent value growth. This is preventing a lot of volatility in case that there are bumps in the markets. Investing in index funds gives you the profit of the entire market. If one sector does poorly and another does well, your portfolio will have very even profits and losses. A bonus is that these come with very low fees, so you can invest more and make more money. Next, you should just keep building your portfolio. To increase safety, you should invest the same amount of money in every part of your diversified portfolio. This means that you're not investing an absurd amount into something risky and a moderate amount into something safe. Investing the exact same amount to every stock, fund, or bond will give you very good returns if you play it smart. Make sure to do this consistently like I told you before. The 4th and final tip is to know when to get out. This tip is just me telling you to make a stop price. This is where you make an automatic command into a computer program to sell when the value of a stock goes under a certain price. This tip is mainly directed towards investing in the stock market. In other investments, you're going to have to keep a more watchful eye on. That was diversification. The final thing I wanted to speak about is tax and commissions. When you invest, there are many different fees and commissions that you have to pay to invest, especially in the markets and real estate. By looking out for these different commissions, you could save yourself a lot of money. Taxes are different for investments than income. By knowing the tax system and how it works, you can increase your profit and gains in the long run when you cash out of the markets. These were less tips and things you should look out for after you've made the profit. If you want to see me go into the tax code or different commissions for different investments, then comment down below. That was the video for today. The things that I spoke about in this video are for almost every type of investing except for 1 or 2 tips. But if you want to see a video where I speak about one way to increase a certain part of your portfolio, then like and subscribe and comment down below telling me what you want to see. Anyways, that was the video for today. Make sure to like and subscribe, and I'll see you in the next video.